Don't prepare a tax return based around trying to avoid an IRS audit. Prepare an accurate tax return and just be prepared for one so you're not scared of it. So obviously the IRS isn't going to tell us exactly how they pick who they're going to audit. There is a randomness factor. There is a lot of data out there about who they audited and what they audited on those tax returns. And so by that, we can come up with probability of one being audited. And so you'll hear a lot of times like, oh, your chances of being audited are, you have better chances of winning the lottery than being audited. Well, that might be true for an individual taxpayer who only has a W-2. But as soon as you own a business, your chances of being audited are astronomically higher. An IRS audit, a true audit, where you get a letter and they say you're being audited, is probably going to happen one of two reasons. Number one, pure random, which absolutely is the case. They're going to have a number that are just pure random. Number two is if your expenses and income for your industry don't mesh with everybody else's that they've received. So obviously they have some complex software that basically is comparing everybody's industry across the United States. And they're going to look at your gross receipts, they're going to look at how much you pay in wages and supplies and all these different categories. They're comparing that with everybody else that's into your industry. And if you're constantly an outlier in certain expenses or possibly your income, then maybe that'll trigger an audit. More likely than not, they're going to be looking at your tax return, maybe not full-blown audit, but you're going to get those notices when you are filing like payroll documents and the payroll doesn't match the payroll that you put on your tax return. I see that. I see accountants who are saying, hey, we'll do everything for you, and the client is none the wiser about how much they're paying themselves for. In terms of a list, it's going to be making sure that your forms match, whatever forms those are, whether it's your payroll forms that you're issuing to your employees, that the total amount matches on your business tax return. Other documents such as 1099s that are provided to you, which report what the IRS is expecting your gross receipts, a minimum of what your gross receipts should be. Any tax expense categories that have a lot of strict rules around it, such as home office that has strict rules around it, so that's why maybe it has more of a red flag. In meals, if you're taking 100% versus 50%, that has strict rules associated with it. So if you're constantly taking 100% of meals or have a much larger number than what the IRS thinks is average, whatever that is, then maybe that could trigger an audit. Or things like the R&D tax credit, which also has strict regulations around it. The IRS, obviously, they're going to have some sort of, they want to make sure that their time is used wisely too. So they are going to audit the things that they know business owners are not as likely to stay up on. So I'll give you an example. Mileage reimbursement. The IRS requires really strict rules. They want you to track every single mile. They want you to have a mileage log, whether it's business or not, and then you figure out how much is business, and they want to know what the business purpose was. If you met with somebody, what did you talk about? Like, why was it necessary for the business? And so if you, especially real estate agents, they have a ton of mileage deductions. So if you're a real estate agent and they're going to audit you, they're going to ask for your mileage log for sure. Because if you didn't keep good records, that's an easy one for them to throw out. And for a lot of real estate agents, that's a big deduction. And so that would result in you having to pay back a lot of taxes. So, but anything else like keeping receipts, they're going to ask you for your receipts. Not just your receipts, but your bank statements and your credit card statements too. Why are they asking you for those things as well? Well, it's because how else are they going to know if you just returned those items? So you can't just keep your receipts. They want to know, they want your bank statements to show that you never returned those items, or that, your credit card statements and bank statements and things like that. And so making sure that you keep all of those things, that's legitimately what they're gonna ask for. It isn't good enough just to have your bank statements or just your credit card statements. They require receipts. If you don't have that, then they can throw it out. I'm gonna say, don't be scared of an audit. That's gonna be the biggest thing. Like, if you're scared of an audit, you are overpaying in taxes. You're scared of taking that extra deduction because maybe it's slightly higher than everybody else in your industry. Don't be scared of an audit. If it is a legitimate business expense, take the expense, document it well, and don't be scared of the audit. And we've had multiple audits. Here at Porter Kinney, we had a client go through a full-blown audit, which honestly is more unusual than people think. We just got done with an IRS audit where it took about 2 weeks and the IRS auditor signed off and said nothing was found. Why was nothing found? Because the client had great documentation and worked through us. We were able to present it to the IRS auditor very quickly, efficiently, and he understood that there was nothing to do. Don't prepare a tax return based around trying to avoid an IRS audit. Prepare an accurate tax return and just be prepared for one so you're not scared of it. Honestly, if they've been doing things correctly, they should expect a smooth process. There's nothing to be scared of. I'd say being polite to your IRS auditor goes a long way. At the end of the day, they're just people too, and being polite to them goes a long way.